Welcome to Iron Financial. Our mission is simple. We help you forge a stronger portfolio by stress testing market narratives and cutting through the weakness. Today, we are putting a massive high-yield name under the microscope, Plains All American Pipeline, ticker PAA. And folks, this company is a walk-in contradiction right now, sending out signals that are just wildly different. I'm your lead analyst, and when I look at the blueprint, I see a calculated, strategic overhaul in progress. And I'm the market skeptic, and frankly, I see a balance sheet that's flashing some serious warning signs. Our job today is to dig in, stress test the structure, and figure out if this is a solid foundation for your money or a house of cards waiting to tumble. Let's get to work.
Okay, let's just jump right into the heart of the matter, the core conflict that made us look at this company in the first place. On one hand, you have a really ugly Q4 earnings report. I mean, they reported 40 cents a share, missing Wall Street's expectations by almost 15%. That's not a small miss, that's a big whiff. But then, almost in the same breath, management turns around and gives shareholders a fat 10% raise on the dividend. So you gotta ask, right, what is going on here? How can a company stumble so badly in a quarter, so publicly, and at the same time signal so much confidence with a dividend hike? Are they playing chess while the market is playing checkers? Or are they just putting on a brave face, hoping no one looks too closely at the numbers? This is the puzzle we're going to solve today. And to get to the bottom of it, we're going to put PAA through our full Iron Financial stress test. First, we're going to dig deeper into that headline contradiction. Then, I'm going to lay out the bull case, what management wants you to see, their blueprint for the future. After that, our market skeptic is going to take the floor and point out every single crack in this company's armor. And believe me, there are a few. Then we get to the main event, our stress test. We're going to pit that mountain of debt against their growth story. We'll take a hard look at that high-yield dividend, and then, at the end of it all, we will deliver the Iron Financial verdict.
To me, this just screams red flag. A miss this big should be followed by caution, by pulling back, not by opening up the wallet for a bigger payout. It honestly feels like they're dangling a shiny object, this big dividend, to distract everyone from a really weak operational quarter. I'm just not buying the story. And look, I get that, but I think you're looking in the rearview mirror. Q4 is already in the books. A dividend hike isn't about the past, it's a promise about the future. Management is telling you, loud and clear, that the foundation they're building for 2026 and beyond is what really matters here, not one bumpy quarter. Let's be absolutely crystal clear about how big this miss was, because miss doesn't really do it justice. This wasn't a rounding error. Wall Street analysts, the people who do this for a living, were looking for 47 cents a share in earnings. PAA came in with 40 cents. That's nearly a 15% failure on the bottom line. But hey, look at the top line, the revenue. That's where the real horror show is. The consensus was for over $13.4 billion. They delivered $10.57 billion. That is a 21% shortfall. They missed their revenue target by almost $3 billion in a single quarter. You can't just wave that away. That tells you there was some fundamental weakness happening in the business during that period. The real question is, was that a temporary pothole or a sign of a much bigger sinkhole opening up?
Exactly. And that's precisely why we have to look past the rearview mirror of Q4. The bull case for PAA has absolutely nothing to do with that earnings miss. It's all about the massive, deliberate transformation that is happening right now. They are fundamentally reshaping this company, and the forward guidance they've laid out is the first and most important pillar of that argument. So let's look at the actual blueprint.
And that first pillar is built on this number, $2.75 billion. That's the midpoint of their 2026 target for adjusted EBITDA. Now, for a company that just missed revenue by over 20%, that is an incredibly bold projection. EBITDA, as you know, is a crucial metric for a business like this, with tons of physical assets. It shows you the raw cash-generating power of the business before you factor in non-cash stuff like depreciation. I mean, think about it. With billions of dollars worth of steel pipeline in the ground, depreciation can really muddy the waters. This number, this $2.75 billion, is management telling us that their core assets are going to be absolute cash cows, regardless of what happened in Q4.
Okay, so that's profitability. But where does the rubber really meet the road? Right here. This is the lifeblood of any investment, free cash flow. After all the bills are paid, after all the maintenance is done, PAI is guiding for $1.8 billion in adjusted free cash flow for 2026. This is the actual cash they'll have left over. This is the money they can use to pay down that debt we're going to talk about, reinvest in the business, and, most critically for income investors, fund that huge dividend. A projection this strong is management pounding the table, saying our cash machine is so powerful it can support everything we want to do and more. This is the engine of the entire bull thesis.
So how in the world did they get from a massive Q4 miss to generating all that cash? Well, it's not magic.
It's a clear, decisive, strategic pivot. They are getting out of a business they see as a drag to double down on what they do best. Right now, they're in the process of selling off their Canadian natural gas liquids, or NGL business. The whole goal is to streamline the company, to stop being a jack of all trades and become a master of one, a pure play focused entirely on crude oil infrastructure in North America. This isn't just shuffling some papers around. This is a fundamental reshaping of the company, designed to focus all their money and all their brainpower on the part of the business where they see the most growth.
And it breaks down into a really clear three-step plan. Step 1. Sell that underperforming Canadian NGL business and get a big pile of cash. Simple. Step 2. Take that capital and immediately reinvest it into their core strength by buying key assets, like the Cactus III crude pipeline. And Step 3 is what they call self-help. This is the part I really like. They're targeting $150 million in cost savings and other efficiencies that have nothing to do with the price of oil. This is a growth plan that can work even if oil production goes absolutely nowhere. They're trying to build a more durable, all-weather machine.
And you don't have to take my word for it. Listen to the CEO, Willie Chang. His language here tells you everything. He's not apologizing for the Q4 miss. He's not dwelling on the past. His eyes are on the transition. He's telling investors, look at the more focused, streamlined organization we are becoming. This is the story they're selling. It's a story of proactive, strategic transformation, not reactive damage control. They're asking you to judge them on the company they are building for tomorrow, not the one that existed yesterday.
All right, that's enough. I've heard enough forward-looking promises and CEO quotes to last me a lifetime. You know, talk is cheap, and guidance is just a guess with a fancy name. I want to talk about the here and now. I want to talk about facts. It's time to stress test the actual audited financial statements, because this foundation the bulls are so excited about is showing some very, very serious cracks. The numbers on the balance sheet right now tell a completely different and much, much riskier story.
First of all, let's put that revenue miss into its proper context. This wasn't just a failure to meet what analysts hoped for. No, this was a significant, measurable decline from where they were just 1 year prior. In the fourth quarter of 2024, they brought in over $12 billion. Fast forward 1 year, and that number has dropped to $10.57 billion. That's a 12.2% drop year over year. That's not a blip. That suggests the weakness we saw wasn't a one-time thing. It points to a deteriorating trend in their ability to generate sales, and that should be a major concern for any investor.
But this is the slide that should keep you up at night. This is the real crack in the armor. While their revenue was falling, their long-term debt was absolutely exploding. Just look at these numbers. At the end of 2024, they were carrying $7.2 billion in long-term debt. Okay, 1 year later, that number is $10.7 billion. That is a 48.4% increase in a single year. They added nearly $3.5 billion of debt to their books. And as a result, their debt-to-capitalization ratio, a key measure of leverage, jumped from a pretty manageable 42% all the way up to a much more concerning 52%. That is a massive injection of financial risk into this company.
And guess what? All that new debt isn't free. This is the immediate, painful consequence of that ballooning balance sheet. Their net interest expense, the cost of servicing all that debt, shot up 42% in the fourth quarter compared to the year before. It went from $112 million up to $159 million. Every single extra dollar they have to pay in interest is a dollar that does not become profit for shareholders. It's a direct drain on the company's profitability, and it's a direct result of this aggressive debt-fueled strategy they're chasing. This is a heavy, heavy weight on the entire financial structure.
And finally, hey, don't just take my word for it. Let's look at an objective, standardized metric that was literally designed to predict financial distress. It's called the Altman Z-score. It takes a bunch of values from the balance sheet and income statement and spits out a single score that measures the likelihood of a company going bankrupt. A score over 3 is considered safe. A score below 1.8 means you're in the distress zone. PAA scores a 2.51. That puts it squarely in what's called the gray area. Now, this isn't a death sentence, but it is an objective, formula-driven warning light on the dashboard. It tells you the company is carrying a level of financial risk that could lead to serious trouble down the road. It basically validates every concern that massive jump in debt raises.
Okay, the Skeptic raises some absolutely critical points. You cannot just ignore that debt load. It has to be addressed head-on. The bear case is 100% valid if you just look at these numbers in a vacuum. But here's the thing, they don't exist in a vacuum. That debt was taken on for a very specific reason, as part of that strategic pivot we just outlined. So now, in our stress test, we're going to connect the two sides of the story. We're going to reconcile the debt from the bear case with the growth strategy from the bull case. The fundamental question is this just reckless borrowing, or is it a calculated investment in a much stronger future?
Let's start with the why. Why are they doing all of this? Why take on debt to buy one thing and sell another? This slide gives you the cold, hard, data-driven reason. Just look at the performance of their two main businesses in the fourth quarter. The crude oil business, which is their new core focus, saw its adjusted EBITDA grow by a healthy 7% year over year. That's the strong, growing part of the company. Meanwhile, the NGL business, the one they're selling, saw its EBITDA collapse by 21%. What they're doing here is financial triage. They are amputating a declining, underperforming limb to free up cash and focus all their energy on the healthy, growing core of the business.
Okay, fine. The strategy makes sense on paper. Get rid of the weak stuff, buy more of the strong stuff. I get it. But that still leaves the skeptic's central and very fair question unanswered. What about that $3.5 billion in new debt? Where did that cash actually go? And more importantly, what is the concrete, actionable plan to pay it back? A cool strategy is totally useless if you don't have a clear path to getting that leverage off the balance sheet.
And here's the answer, right from their cash flow statement. That new debt was used for acquisitions, with the Cactus 3 pipeline being the main purchase. This is a critical distinction. The debt wasn't taken on to plug a hole in the business or to fund the dividend. It was investment capital. It was used to acquire a strategic asset in their core growth area. And the repayment plan is just as clear. The proceeds from selling that Canadian NGL business are specifically earmarked to pay down this exact debt. It's a two-part transaction that's just not fully completed yet.
And this right here brings our entire stress test into focus. Management isn't hiding from the high debt. They acknowledge it. Their leverage ratio at the end of the year was 3.9 times their EBITDA, but they are explicitly telling the market that this is a temporary situation. Their long-term target range is between 3.25 and 3.75 times. They expect to be right back in that comfort zone as soon as the NGL sale closes. So you have to see the high debt level for what it is. It's a bridge. It's a temporary financing tool to let them buy the asset they wanted before the cash from the sale comes in. The entire bull thesis hinges on their ability to walk across that bridge and close that sale.
Which, of course, brings us to the final, critical piece of this puzzle, the dividend. That 10% hike is the shiny object that started this whole conversation. For anyone focused on income, a high and growing yield is like a siren song. It's incredibly attractive. But as any seasoned investor knows, an unusually high yield can often be a warning sign of huge underlying risk. We call it a yield trap. So we need to figure out if this 8.5% payout is a legitimate opportunity or a very dangerous trap.
And at around 8.5%, this is definitely a high yield. In this market, that kind of return is almost unheard of from a large company. But given everything we've just laid out, the huge earnings miss, the revenue decline, that shocking 48% jump in debt, you have to step back and ask a serious question. Is this sustainable? Can a company with all these financial pressures really afford to be sending this much cash out the door to shareholders? It just feels like something has to give eventually.
And this right here makes me even more skeptical. You see, at the same time they announced the dividend hike, management also quietly announced they were lowering their own safety standard. Their distribution coverage ratio threshold, that's the minimum cushion of cash flow they promised to keep above the dividend payment, was lowered from 160% down to 150%. So let me get this straight. They're increasing the payout while simultaneously reducing their own margin of safety. To me, that looks like they're giving themselves less room for error at the exact moment when the risk of something going wrong is at its absolute highest.
But this is where context is absolutely critical. Yes, they lowered the official policy, the threshold, but their actual performance tells a much, much stronger story. In that same fourth quarter, their actual distribution coverage ratio was 1.79 times, or 179%. So even after paying out that big dividend, they still had 79% of that amount left over in cash. That is an incredibly strong cushion. It's well above their old 160% target and miles above the new 150% target. So the bull argument here is that lowering the threshold isn't a sign of weakness at all. It's a sign of confidence. They believe their cash flows are about to become so stable and predictable that they can safely operate with a slightly lower, but still very, very robust safety margin.
All right, we've gone deep on the contradiction. We have built the bull case from management's own blueprint. We've hammered on the bear case and pointed out the cracks. We've stress-tested the debt against the growth plan, and we have dissected that dividend. Now, it is time to put it all on the scales, weigh all the evidence, and deliver the final iron financial verdict. Is this company's structure solid enough to earn a place in your portfolio?
So the bull case, it rests on a solid foundation of a forward-looking, intelligent strategy. Management has laid out a clear blueprint. They've put out very strong guidance for 2026 free cash flow, which is the ultimate measure of a company's financial health. They're executing a smart strategic pivot, getting out of a declining business to pour resources into their core strength in crude oil. They're creating their own growth through cost-cutting, and they have shown a clear, unwavering commitment to returning a ton of cash to shareholders. This is the picture of a company actively and intelligently forging its own, much stronger future.
But you simply cannot ignore the cracks in the armor that are visible today, right now. The fourth quarter performance was, without question, weak. The balance sheet has been loaded up with a truly enormous amount of new debt in a very short period of time. That debt is already driving interest costs higher, which eats directly into profits, and objective third-party measures like the Altman Z-score are flashing yellow warning lights. These are not theoretical risks down the road. These are concrete, quantifiable weaknesses in the company's current financial structure.
So our final verdict is this. Plains All American is not a simple buy or sell. This is what we call a special situation. For a disciplined income investor, one who understands the plan and is willing to accept the very real risk, this presents an opportunity. It's a chance to lock in a very high yield from a company that is right in the middle of what could be a powerful, value-creating transformation. But, and this is a big but, for any investor who is wary of execution risk, this is a potential trap. The entire investment thesis, the entire bull case, the safety of that dividend, all of it, it hinges entirely on one thing: management's ability to execute their plan flawlessly. They must close that NGL sale, and they must integrate the Cactus III pipeline effectively. If they do, the stock is probably cheap right now. If they stumble, that heavy debt load could become a very serious problem very quickly.
And so we leave you with the one final question you need to consider for yourself. After seeing both sides of the argument, the bull and the bear, do you believe management is truly forging a stronger, more durable company for the future? Or are the bold guidance and the big dividend hike just an attempt to paper over the very real cracks that have appeared in their financial armor? The answer to that question will determine if PAA is a solid block in your portfolio's foundation or a risk you should avoid. As always, do your own due diligence. This is Iron Financial, signing off.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.